If you've been trading the crypto markets lately, you are probably feeling the chop. You enter a trade on a strong breakout, and immediately the price reverses, stops you out, and leaves you staring at a sea of red. Many retail traders are getting caught in this cycle because they're trading on a specific expectation, the idea that the Federal Reserve is about to slash interest rates and send us straight back into a massive bull run. These sudden green candles function as a liquidity trap. Market makers are actively pushing prices up just enough to bait in retail buyers, only to sell into that demand and wipe out those deposits. To survive this environment, you have to step away from the 5-minute charts. The market right now is being dictated by 3 larger forces: actual Fed policy, global energy shocks, and the hidden liquidation levels of institutional players. At their most recent FOMC meeting, the Federal Reserve confirmed what the data has been pointing toward for months. They kept interest rates completely flat. The broader market had aggressively priced in rate cuts for the near future, but Jerome Powell has actively pushed back against that timeline, making it clear that current economic conditions simply do not support an easing of monetary policy. Behind closed doors, there is serious division about how to proceed. Several regional bank presidents disagree on whether to hike or cut. With incoming leadership uncertainty, including Kevin Warsh likely stepping into a key role, that internal friction is paralyzing their ability to act decisively. Cutting rates now while energy costs are rising would likely ignite a secondary inflationary wave. This chain reaction could force the Fed to implement even more restrictive hikes later on, creating the exact market crash they are trying to avoid. The primary reason the Fed's hands are tied right now is sitting in the physical world. Global energy supply shocks are keeping inflation incredibly sticky. Rising geopolitical strain and naval blockades in the Middle East have disrupted major shipping lanes. That pressure is forcing Brent crude oil prices up to new local highs. Add in the threat of renewed political interventions and aggressive trade tariffs, and the cost of importing goods remains artificially elevated across the board. This chart tracks the XLE, representative energy sector, against the price of Bitcoin. Historically, we see a clear inverse correlation. Energy sector prices tend to be peaking exactly when the crypto market is finally finding its bottom. As long as these global conflicts keep oil prices high, inflation won't drop to the Fed's target. That forces interest rates to stay high, which starves high-risk assets, like cryptocurrencies, of the cheap capital they need to rally. The realization that rate cuts are indefinitely delayed is finally bleeding into traditional equities. Looking at this 4-hour chart for the S&P 500, we can see a clear bearish divergence forming. Even as the asset's price tried to push upward, the momentum indicator printed lower highs. This divergence indicates that the market is shifting from a steady climb into a period of choppy, sideways consolidation as buying pressure exhausts itself. Capital flows follow a strict hierarchy. When lower-risk traditional equities lose their momentum, investors take profits. The first place they pull that liquidity from is the highest risk tier of the market, altcoins. That macro weakness brings us directly to Bitcoin's current make-or-break level. The price is actively retesting a crucial zone between $72,000 and $76,000, trying to turn that old resistance ceiling into a new support floor. If buyers fail to hold that $72,000 level, the structural damage to the chart will be severe. A breakdown there points to a rapid slide back down into the mid-$50,000 range. This is a Bitcoin liquidation heat map, showing where institutional players have parked their orders. There is a heavy concentration of liquidity sitting right between $79,000 and $80,000. If macro conditions ease, that pocket will act as a massive magnet for the price. Ethereum is fighting a similar uphill battle. It is struggling against heavy resistance at $2,400, and the data suggests it will likely drop to test its major support floor at $2,100. These specific support zones are exactly where market makers will spring the liquidity trap, wiping out the over-leveraged traders who bought into the fake breakouts. Leveraging into short-term momentum exposes your capital to significant risk, while energy-driven inflation paralyzes the Fed's ability to cut rates. Your priority must be capital preservation. Stay patient and only engage the market when those major structural support levels are properly tested and confirmed. Long-term profitability doesn't come from betting on what you hope the Fed will do. It comes from trading the hard macroeconomic facts, leaving the illusions behind.